But this data is highly accurate over the years that we've gathered. And this is what we're doing is we're taking this data and turning it back to the founders and saying, this gives you a guide. So the number one question we get is, I am this type of founder in this space, my revenue is this, and I'm looking to raise a round. What do you think, what format should I use? And then what valuation range do you expect me to get there? And how much money should I raise? Is kind of like the three most common questions we get. Hopefully, by publishing this data, it gives founders a guide that basically you can self-service an answer to that and do your own math on all this.
Welcome to Triangle Tweener Talks, a weekly podcast by builders for builders where we explore the startup journey from the idea to the exit and all the lessons in between, with an exclusive focus on founders from the Triangle region of North Carolina. Now here's your host, serial founder, and general partner of the Triangle Tweener Fund, Scot Wingo.
First, a huge thank you to our gold sponsors. Today we are featuring Robinson Bradshaw. With national reach and deep Triangle ties, Robinson Bradshaw delivers high-touch, sophisticated legal counsel to emerging growth companies and venture investors. We'd also like to recognize our silver sponsors. Today's Tweener Talk features Automated Consulting Group. From AI strategy to ROI in 90 days, Automated Consulting Group brings executive-level AI expertise to businesses without enterprise budgets. Finally, thank you to our sponsor, Extensis HR. So that founders can focus on innovation for over 25 years, Extensis HR has leveraged a people-first approach, customer-centric mindset, and deep industry expertise to ensure employers have the tools they need to stay competitive in today's market. Thank you again to all of our sponsors for supporting Triangle Tweener Talks and the entire Triangle startup community. It takes an ecosystem to build a thriving community, and sponsors like these are very valuable, and they contribute their time and also help sponsor things like the Triangle Tweener Talks and Triangle Tweener Times. Thank you. Hey everybody, welcome to Triangle Tweener Talks. I'm Scot Wingo, general partner at Triangle Tweener Fund. Usually I have a guest, but we're going to mix it up this time. Think of this as the holiday edition, so it was pretty hard to get some guests to come on. Everyone's really busy this time of year. But what I thought I would do is I did a series on Tweener Times about the funding in the Triangle that got a lot of engagement, a lot of questions. People really enjoyed that. So I thought I would put out this enhanced version of that data with a lot more color commentary than is able to be put into a Substack post. So we're recording this on December 16th. So this is going to cover the data all the way through the end of Q4. The way Tweener Fund works is we're typically done by December 1st this time of year. Not a lot of deals are gonna pop on the radar that have to be done quickly in December. So this is pretty much all the way through 2025. The original two-part series you can find on Tweener Talks, or Tweener Times, and it was a two-part series. The first was out on December 10th, the second on December 14th. In this series, we analyzed over 220 of the early-stage venture deals that we participated in the Tweener Fund. All of them are in the Triangle, and they all are early-stage companies. So this covers 4 years of data, so roughly, you can do the math there, 50 companies a year. And what's interesting about this data, we couldn't provide this earlier because one of the things we don't want to do, this is a company's most treasured data. They don't share it openly. We take that seriously. We treat it as confidential. But what we can do is anonymize it, and that's what we've done. So there's no specific companies that will be mentioned here. We never go less than 10. So if there's 10 companies in a cohort, we can anonymize it and aggregate that data and not reveal any one company's information. Anything less than that, we start to get concerned about people being able to back into that, so we don't provide that data. The other thing I'll share is these are all companies we've invested in, and we're most active in the pre-seed and seed stage. When we start looking at the A, B, C rounds, we don't do as much there because we're only 4 years. Our companies are just starting to get to Series A. We've had, you'll see how many of those we've had. Most of Series A's, I would say 2/3 of them are follow-ons, meaning we were in the pre-seed or the seed or whatnot. Some of them are. We do get occasionally invited to these later stage things. Usually it's founders we know here in the area that haven't raised around since we started the fund, so that's our entry point. But that's the minority, or a pretty small part, usually like 25% of those tiers. What's interesting is you will not find this data anywhere else. So this is not on PitchBook. It's not available from any of the other local investors. No one is in as many deals in the Triangle as we are, and no one sees as many deals and actually invest in them. We don't invest in every deal, but what I can tell you is that this has given us, I can pretty much pinpoint in 4 or 5 questions a founder, what they're building, their stage, the category they're in, their experience, and give you a range of outcomes. And we have like 95% probability of nailing that. There's outliers and lower things and whatnot. But this data is highly accurate over the years that we've gathered. And this is what we're doing is we're taking this data and turning it back to the founders and saying, this gives you a guide. So the number one question we get is, I am this type of founder in this space. My revenue is this, and I'm looking to raise around. What do you think? What format should I use? And then what valuation range do you expect me to get there? And how much money should I raise? It's kind of like the 3 most common questions we get. Hopefully, by publishing this data, it gives founders a guide that basically you can self-service and answer to that and do your own math on all this. Part of our values as at the Triangle Tweener family of companies, I call it the Tweenerverse, is to be transparent and support the community. So that's what we're doing. We're so excited to share this data, but we'll always take confidentiality over transparency. So that's why we like there to be these cohorts that we can anonymize the data, aggregate it, and still provide a lot of value without getting into what's going on at specific companies. Okay, to give you a little more context, I'm going to give you a brief history of the Tweener List and the Tweener Fund. So in 2015, I started the Triangle Tweener List, and I had this idea that I'm not a go-to-market expert, but I know you have to have multiple stages to a pipeline. And at this point in the Triangle, we had what I would call leads and closed deals. So we knew there was all these startups, and then we know there was 5 or 10 companies that were going to be successful. Pendo, even in 2015, was in that category. They were already off to the races. Companies like Levitate, so on and so forth. But then that was it. So we knew like there's these 10 companies that are kind of our probably going to be our heroes, but we don't know who are the up and comers in this sea of thousands of startups. So I thought what we need is a middle part of the pipeline, and I decided I could help with that. So I just published what I decided to call the Triangle Tweener List. And I came up, after a big analysis that I won't bore you with, I came up with this idea that I would use LinkedIn as the main source of information. So that way I don't have to ask everybody their private information like, hey, I'm Scott, what's your revenue? That's a weird conversation for a founder to jump into. So I can actually go look up the companies on LinkedIn, see their headcount, and then you can basically use some rule of thumb math to back into their revenue. And it turns out that if you're a tech company in the Triangle, biotech is outside of all this, that they have their own rules of the road that we don't really do much with them. So they're not included in everything I'm going to say from this point forward. But outside of that, if you have 10 people, then you're probably knocking on the door for $1 million ARR. And if you have 20, you're probably close to 2, so on and so forth. AI has actually skewed that. A lot of 10 people companies are actually doing higher, but it still is a good, as long as it's higher, not lower, it's a good approximation. So the rule is you enter the Tweener List territory once you get to 10 people or $1 million ARR, which is basically 80K MRR. And then you exit at 80 million revenue, which is usually 500 people. You do get efficiencies, so it's not a linear progression there. So, and those are Triangle Tweeners. So you have to be based in the Triangle. You have to be a high-tech company, no service companies, no professional services companies, no lawyers, no accountants, none of those types of things, no developer shops, no consultancies, no resellers, no biotech, but every other category. And you have to have intellectual property is kind of another way to think about it. And then the way we think about biotech is, do you require FDA approval? If you do, in our mind, you're a life science or a biotech company. If you're going to be providing software that works on a device that doesn't require FDA approval, that's okay. That's a health tech company in our taxonomy. So that was the Triangle Tweener List. And let me just kind of pop over here. When I started, there was 48 companies I could find that were Triangle Tweeners. I'm going to go to this mode. And you can see that this has grown to over 300. I think it's 312 here in 2025. There's a lot of unintended consequences from doing this. One of which is we ended up, I never thought I would track it over this long. So it's got a life of its own. So I think this is probably the best measure of a health of an ecosystem or the future health. Let's say this is a forward-looking measure of how things are doing. A lot of times you'll look at exits. That's kind of the latest of stages. You'll look at fundings. That's decent, but again, I think it's actually more interesting to look at like who is starting to get, how many companies in your ecosystem are getting lift-off velocity. And that's what I think about. And you can see that this is 6x in 10 years. So I think the health of our ecosystem is pretty amazing based on this. And then the other unintended consequence is over time, I started to realize I started tracking exits and fundraisers. And what I started to realize by doing that is there's lots of companies in the Triangle that local investors don't invest in. I'm an LP in the 3 local investors, co-founders, Idea Fund and Bull City. And, only one of those is in Pindo. And there's a lot that weren't in some of the bigger exits we've had, like Archive Social didn't have one of those 3. And then maybe Dave Garner was personally, but I don't think co-founders was. And then Cloud Factory, Samanage. I have a list of like 60 exits, and the bulk of them don't have a local investor. And I thought, well, that kind of stinks, because what happens is Silicon Valley or Northeast VC firms come in and cherry pick our best companies, and they basically pay up, and the local people, for whatever reason, miss out on this. So I thought that's not great. How can we work on that? And in 2022, we started working on a mechanism to help with that. The other thing that's happened is the local funds have done very well, and they've grown. So they started out like in the $15 to $20 million range, and now they're 80 to 100 million. And the way this math works, the way the SEC is set up, you can only have so many LPs. You have to take this, divide it into the LPs, and you basically end up with the amount that you have to invest goes up. So it used to be maybe 100K you could get into those funds, and now it's like 300 or 400K. And that really prices out a lot of people that want to be angel investors. So I was wondering how could we solve some of these things? And also I started thinking, I just wish I like to invest in the public stock market in indexes and pick some. I like a barbell strategy of doing the high risk thing and the low risk thing, and it balances out. So I'll invest some in companies I know, which are usually the internet companies. And then I'll also do like an S&P 500. And over the years, that's been a great strategy. If they don't, it's rare that they both don't work. So usually one of them is working, and it counteracts the other one if it's not working. Okay, so I came up with this idea that what if the Tweener List is like the S&P 500, and could we create a index private company fund? So as Vanguard, which is the company that pioneered this idea of index stock market ETFs and whatnot, they have the largest S&P 500, to my knowledge, fund. What if we could be the Vanguard of private companies in the Triangle? And that's what the Tweener Fund is. We also decided at that point in time, it was 20K a year. We've raised that to 30K because we hit the LP limit ourselves. But we're keeping it. It's the lowest way that you can invest in private companies in the Triangle. So the annual commitment is only 30K compared to, which is, only 10% of what it would be to be in one of the big funds in town. So we launched that in 2022. And the idea is we're going to try and invest in as many companies on the Tweener List as possible. And that gives us a possible addressable market of 320-ish or so. Now, some of those you won't be able to invest in because they're later stage or they're bootstrapped and they don't want to have investment capital, which is fine. Some of them, also, we've increasingly gone a little tier below because this kind of Tweener, not tweener space is a big space. It's like from 0 to 80 million, 80K MRR, is a big window. So we'd like to increasingly get in a little bit earlier. 40, 60 MRR is interesting. And if it's a serial founder, we usually, the data shows that serial founders tend to outperform first time founders. So we'll go earlier on this. So that's the history there. So, what you're going to be looking at is 4 years of data if you count, 22 to today of the Tweener Fund. Other things in the Tweenerverse that we launched last year. We launched the Triangle Tweener Times, which is where this report showed. You're watching Triangle Tweener Talks, so you're familiar with that. And then we also have the very popular Triangle Tweener Community Hub, which is at tweenerhub.com. This was another response to frequently asked questions we got that were, I'm moved here from Boston and I want to meet more people in the area. Is there a community where I can do that? I'm looking for a lawyer in town that understands startups. Who should I talk to about accounting? I'm looking for a fractional CFO. This hub answers all those questions. I want to go to some really interesting events. Is there a calendar that aggregates all this? Yes, there is. We've built that. And then last year we launched, in the spirit of March Madness, we launched a pitch competition called Tweener Madness. And that was exceeded all of our expectations on popularity. Turns out founders love to watch other founders pitch, and you learn a ton from that. And I always like to go to Venture Atlanta and all these other pitch competitions, pitch events, because I can learn both what to do and what not to do from watching other people pitch. And it's a great way, to get if you enjoy Shark Tank or something like that. It's kind of cheesy. These are not cheesy. So this is like real pitches with real investors. I think you would enjoy that content. And that will be back in 2026. So focusing in on the Tweener Fund, over this period of time, we've invested a little over $11 million in 228 transactions in 166 companies. You may have a question, what's the difference in those numbers, which is approximately, let's see, what would that be? 62 company difference. And the answer is that's follow-ons. So I'll show you the different stages, but a lot of times we'll invest in company when it gets to 80K MRR, and then they'll raise another round later. So that's usually a seed, and then we'll go into an A, and then we want to keep investing an A and a B and whatnot. So 60 of our companies, of our 166 companies, have done follow-ons, which is more than a third. So that's a really good indication. So when companies start to progress and get to the follow-on stage, that's usually an indication of success, because investors aren't going to keep investing if there's not an underlying success of the company. The Tweener Fund strategy, I talked about this. Let me just restate it. There's basically 4 pillars that we think about. Number one, we are an index strategy. So we every quarter we invest in 10 to 15 companies. And that's why we have so many investments. Lots of small checks. We want coverage over an ownership percentage. History has shown that this strategy actually delivers superior returns unless you're very lucky and get 2 power law companies in a fund. And that's the power law companies where it returns like 20, 30, 40, 50x. There's only like 10 really big power law companies. It's obvious ones like Google, Facebook, Uber. Any company you go and look at that has a $100 billion market cap is kind of a power law company in the public markets. We go early stage. So we like it right when you cross 80K MRR or $1 million run rate annually. We will go earlier. We don't typically enter later. We just dabble in that if it's a founder we know. 100% in the triangle. We have a very clear definition of what that is. I won't go into it. It does not include Burlington, the mountains, or Wilmington, or South Carolina. Or Charlotte. And we create a virtuous cycle. So part of what we do, and this is the community aspect, is all these founders we're investing in, there's multiple founders per company. So 166 companies, that's probably 250 founders that we're supporting right now. It's not in writing, but what we hope to show is that founders, this is how I started. Everyone starts first company. So first time founders, if you're successful and we help support you, we would love for you to be an LP down the road. Of our LPs, we have about 100 active LPs. At least half of them are other many time founders. So it's founders supporting founders for the largest part, and then the ecosystem supports all that as well. So that's the flywheel. Is hopefully this creates an evergreen opportunity down the road. It takes 10 to 15 years for these things to get really wound up, but you can see there's something going on in the triangle that's really working, and we want to A, keep that going, and B, see if we can accelerate it through this mechanism. This is what it looks like over time. So slow and steady wins the race. So you can see here the investment is the orange line that trends up and to the right from zero. That first quarter, we invested 562K and all the way to where we are now. And then the number of transactions that we've done there. Some of these numbers aren't always going to align, and that's just timing things. Or when you see the data set, we've taken some companies out that were not appropriate to have in this data. Maybe it was a recap or a different situation that doesn't follow the data we want to present. So it had to be taken out of the data set. We get a lot of questions that say, oh, you must focus on, Scott, you come from e-commerce, so you must focus on that. Couldn't be further from the truth. The best thing about the triangle is the diversity of company type we have. You can see we have some concentration, and I apologize that the thing is over there. We have some concentration on health tech. You can't see it, but it actually goes to 40 on the chart there. And then we have prop tech and consumer. So you can see there's just a really wide range of different things going on. And, so for example, we have an ag tech company. We have a material science company. We just invested in our first space company. I don't think they're on here yet. And robotics. So we have such a diverse set of companies in the triangle. I think that's our strength. That way, if right now in Silicon Valley, everyone's putting all their money into AI companies. Well, they go through these boom bust cycles because they do that. Everything was in crypto 5 years ago, and now that's in a bust. It was a boom, and now it's in a bust cycle. So this is what smooths out our growth in the triangle, is doing this. Okay, let's dig into the data. We're going to talk about 4 different kinds of funding rounds. And this is really tricky because everyone has a different way of thinking about this. So, for example, when venture capitalists think about funding round, they tend to do it by the amount raised. So if you say, hi, I'm Scott, I'm raising $5 million, they'll think late stage seed. If you say, hey, I'm Bob or Sally, and I need 500K, they'll think pre-seed. If they're from Silicon Valley. Anywhere else, they may say pre-seed or seed, not exactly sure. We'll have to kind of learn more. We don't think of it that way at the Tweener Fund because our whole premise is based on the Tweener mechanism of you're at $1 million ARR. That's what we think of here. We map these to company stage. So we've had some companies that are, what's a good example? The other thing we have that's weird here in the triangle is we have a set of companies. I would say there's probably like 20 that we have that don't want to raise a lot. And even though they are in a Series A progression, in my mind, they're well past $1 million ARR. They're 2 or 3 million ARR. They're like, you know what? We need like $1 million to get to profitability. So they don't really follow this traditional Silicon Valley 20% dilution every time around. So we have a lot of rule breakers in the triangle, which is why we prefer this mechanism, which is funding around named by company stage, not amount raised, not valuation, stage. So basically, if you are a company that doesn't have revenue, doesn't have a product, but you have a product but still no revenue, and maybe you have just a little bit of revenue. Again, I kind of draw the line of up to 40, 60K MRR, you are pre-seed. And then once you get to that 60 to 80K MRR, you are a seed company through to, let's call it 2 million. This is where it gets a little kind of tricky. What you want to do is see the company through product market fit. And the test there is their acquisition engine, is their go-to-market motion repeatable? And by repeatable, it means you have more than one person selling. You know who your ideal customer profile or your ICP is, and you can define it and tell me where they are, how big, how many of them there are, and you can basically roll up a TAM from that. That kind of thing. So you're starting to get past founder-led sales into more of a go-to-market motion, and you start to have some pull from the market. So you're not just always doing outbound; some inbound is coming to you, or you have a happy customer that sent you to 2 others. Those are the signals that typically we look for if you're through product market fit. Series A companies are definitely through product market fit, and they're getting into these scaling or these growth rounds. And that's what you see A and B and whatnot. In Series A, you're starting to think about how is the founder building the company? How are they thinking about, okay, I have to have this support mechanism for all these customers. I have this going on in engineering. I now have a group that makes sure my infrastructure is aligned and doing continuous implementations of rolling out things. We're multi-tenant, and we're starting to get through all these different complex things that happen as you start to scale up. There's three funding types basically for raising a round. There's a lot of esoteric stuff, but here in the Triangle, there's basically three. We don't do a lot of secondaries. We don't do a lot of pipes or any of these other. We don't do a lot of crowdfunding. There's been two or three. That's not really included in here. We do a lot of these three. So it's like chocolate, vanilla, and strawberry is basically how to think about this. There's one of these three. The first two are SAFE, which is an acronym for Simple Agreement for Future Equity. This was invented by Y Combinator, which is the Silicon Valley accelerator, commonly abbreviated YC. So if you go through LinkedIn and there's all these other founders with YC, S25, I think that's Summer 25. They do these cohorts, seasonal cohorts. So everyone always, if you're in the YC community, you put YC and then your cohort. This was actually a reaction to convertible notes. So convertible notes are very heavy. They're typically a 10 to 20 page agreement. They have they're very investor friendly. The YC would argue they're not entrepreneur friendly. I agree with that. As an entrepreneur, I do not love these things. They have like a million little sweeteners for the investor, and almost, in a million ways you can trip up for the founder. The SAFE is way more founder friendly. So a lot of investors, there's 3 or 4 angel groups in the Triangle, and big angel investors that refuse to use SAFEs because they like to convertible note for those reasons. There's also this argument of when does the capital gains clock start? I kind of think that's this super edge case and doesn't really matter, but they think it's really important. So something to look for when you do this. I have a lot of first-time founders ask me, like, why do these exist? And the answer is, if you're just two people and an idea and some code and maybe a customer, maybe you have a product, maybe you don't, no one knows how to value this thing. So both the convertible note and SAFE have this feature that is basically saying, look, you, the founder, don't know how to price this, because the founder's incentive to say it's worth 100 million, and then the investor's incentive to say it's worth 0, and then that's a big gulf to cross. And we don't have any data or signal to kind of figure out where it is in that range of 0 to 100 million. So what we do is we decide to kick the can on valuation. And you take the hardest variable and you take it off the table, and now you're left with, you can get to a deal. So that's what these two mechanisms do. And what they do, this is hard for first-time founders to get your head around. They price off a future event, which is the priced round. So they're basically saying, if you're successful, you will do a priced round. That's kind of a commitment of doing these. It's actually in writing in the convertible note. It's not in the SAFE. And then the convertible note actually has a time frame on when you're going to do it, or it basically says in 18 months, whatever it is, that's a variable, but frequently it's a year to 12, 18 or 2 years. You will raise a round, and we will convert into that round. That's why it's called a convertible note. And anyway, what you're doing is you're then saying, okay, if we all agree, we're going to price off a future event. We don't know what it is. We'll call it X. Now the question becomes, what should I, the investor, be rewarded for doing it now? So if that's going to be in 2 years or less, I'm taking risk now, way more risk than they are, and I should be rewarded for that. And there's 2 mechanisms for capturing that reward or discounted price, basically, for taking that extra risk. And they are the discount and the cap. So let's use some math on this. So let's say in a future round, a very common one, we'll actually use some of the data. Here, let me look at it. For seed, our average cap is 16 million. Okay. So let's say we do a 20% discount and 16 million cap. So the way it works, it's a what is better for the investor? Which one gives the investor the biggest? It's an or. They don't both apply. Okay, so it's not an and, it's an or. That's very important. I get in arguments about this all the time. 100% it's an or. It is not an and. Number 2, let me walk you through an example. So let's say we agree that we're going to put a cap at 16 million with a 20% discount today on this thing. We don't know how it's going to be priced. 2 years we do our round and it's at 20 million. The 16 cap goes away because you're above the cap. And now the OR kicks in. So, the 8. Okay, so what we do is we do the math. 20% of 16, I should have chosen an easier one, is 3.2. 16 minus 3.2 is 12.8. Or we have a cap, we have a cap of 16. Okay, so 20, sorry, let me read this. 16 cap, 20 round, 20% discount. 20% discount on a 20 round is 16, so we actually come in at the cap. So it's a tie. Let's say we raise money at 30 million. 20% discount on a 30 million round is 24. Our cap is 16. The investor gets the better of those two, which is the lower price, which is 16 million. So the cap if you raise money way past the cap is what usually happens. And if you raise below or at the cap, then the discount kicks in, is how to think about it. Okay. So it's a goalpost, and then and the discount is protection in case you go way over the goalpost. Now, sometimes people will do a discount only safe, and the investor risk this runaway valuation because there's no cap. Other times there'll be a cap, and what the investor risk there is that it comes in below that cap. So that is how that mechanism works for both a SAFE and a YC. And remember, it exists because we don't know what to price this for today, so we're going to price it off the future. So that's what all these terms are talking about, is that future fixed price round. All right, so in a SAFE, it's a lot simpler, so let's start there. So you have your cap and discount percentage, and it's usually stated as you can read the SAFE thing. Then a lot of people will say, we want a most favored nation, because what happened is a lot of founders were issuing these safes like candy, and they would come to certain investors and say, you seem gullible. I'm going to do these terms for you. And then over here, I'm going to give them better terms. And this basically makes sense that all the safes, this is basically a commitment that says, if you do one lower than what we have, we get that lower price. And then a lot of times investors, if you're raising a lot, they may want a pro rata side letter where they basically say, all right, I'm going to put in, you're raising a safe of 500K, and I'm going to put in 250. And for that, I want at least 20% in the priced round. So I want to make sure that I'm taking this risk today. I can keep a pretty material percentage going forward, and I want to have this side letter. All that is very common, and most deals in the triangle have one or two of those. Most deals in the triangle have a cap and a discount. In Silicon Valley, it's really common to do a discount only. You will not see that in the triangle because we worry about these runaway valuations. Every investor's been bit by this, and so have we, and we really prefer a cap and a discount. So they're very rare to have just one and not both. Convertible note is like super complicated. You usually need a lawyer to explain it. So think of this as not legal advice, but just a quick drive-by of what to worry about here. Take everything I just talked about for the SAFE on the cap and discount. Now we add in some really gnarly things. So I mentioned it has a conversion time and a time frame. There's also like what happens at the conversion. So sometimes it'll convert at the cap. Sometimes it'll be punitive and say, we're going to convert at the cap divided by 2 or something like that. So you have to really read these terms to understand what's going to happen down the road. There's a lot of future thinking in the convertible note. It also has an interest rate. And this always confuses everyone. I just saw one today that has an 8% interest rate on it, which is a lot, right? That's like you could go get a mortgage right now for 4%. And it feels like debt, but here's the trick. It's not. You're not going to take the cash you get and pay this off. It's implemented as what's called paid in kind. So what it does is they basically, if they put in, let's say an investor puts in 500K, and let's use 10% to make the math easier every year. Basically, their 500K over a year is going to have a 10% coupon to it. So now I get an additional 50K applied. It's as if I had invested 550K, an additional 50K when this converts. So it basically is giving me an additional discount. Now, the investor argument is that creates an incentive for you, the founder, to get a price round done quickly, because the longer this is out, if you had this open for 3 years, the clock is really going to eat away at you dilution wise. So that's the argument. Again, I feel like it's punitive. So that we don't see a lot of those anymore, and we'll get into details. Then you get into the holy grail, which is the priced round. And the priced round, again, this is not legal advice. These things, if the convertible note is 10 to 20 pages, this is going to be 50 to 100 pages, even bigger as you get into Series A and B, because you start to put in all these other goodies for the investor. And in there, what you're doing is you're creating, typically, these are not common stock. You do see, we've probably maybe had 3 in the life of the fund. So that's unusual to have common stock. It's usually a preferred type of stock. And so the founders have common and the investors have preferred, and it comes with some special control vectors and mechanisms that make it a sweetener for the investor. The number one is it basically establishes a well, the terms here, you typically have a valuation. So what is the pre-money? How much are you raising in the post? So if we have a 10 million pre-money and we're raising 2, our post is 12. So pre-money plus amount raised equals post-money valuation. Always. That's the algebra of this thing. So if you know one of those 3, you can back into the other one. If you know a company's post-money and what they raised, you can just subtract and get the pre-money. If you know how much they raised, well, then also what you do is, let's say you do 10 and 2 and the post is 12, the dilution is 2 over 12 or 1/6, 18%. So you take, to get dilution, you take how much invested over the post, and which is basically invested plus pre, and then you get to your percentage solution. Because we've done so many deals, I just like do this math in my sleep, but you'll get used to it. If you watch a lot of Shark Tank, you'll see them work this math in real time too. It's basic algebra. You can all do it, I promise. No calculus involved in investing until you get to Black-Scholes, but we won't talk about that. Okay, so then you also have there's a treatment for the option pool. And what investors like to do is push that dilution onto the founders. And a lot of times, first-time founders and even multi-time founders will get a vesting. So a lot of times you'll have owned your shares, and then the investors will say, I'm only going to do this if you will lock in for 4 years. They have a valid reason for doing that. There are many cases where people invested and the founder just pieces out. And this solves that problem and creates a very strong incentive for the founder to be engaged for whatever the vesting schedule is. There's 1,000 other terms that come along with this. The one that gets talked about most with founders is liquidation preference. The way this works is if you do, let's say you raise that $2 million and they own 18% of the company. And later we sell this company for $100 million. So what happens is you have what's called the cap table and a waterfall. The cap table is basically a spreadsheet or a carta that captures who owns what in the company. But then it always has a special treatment of how it flows through when the dollars come in at the top. And that's the waterfall. So $100 million comes in. Well, the first thing is investors get their money back. And so you basically pay them back. And that's the liquidation preference. So if it's 1 times, then they put in 2, they get 2. Now you have 98. But let's say it's got a 5 times liquidation preference. They get 10 back. So 5 times 2 is 10. So $100 million acquisition. I have to pay them back 10 because it has a 5x we abbreviate it LICPREF, liquidation preference, LICPREF. And now I have 90 million. Now the 90 million gets split up into the pie chart that's represented by the cap table. They get 20% or 18%. The founders get the other 82%. This always surprises founders when they're doing acquisitions. Like I was talking to some founders recently that had raised money at kind of like, raised a fair amount of money, and it was like a $50 million. And that, I kind of mentally walked through the math, and they were a little shocked about how little they were going to get in a take home because of this liquidation preference. In pre-seed or seed, it doesn't matter. But once you get into A and maybe a little bit of B, it really matters. And this is something you should be aware of as a founder to understand how this works. I've talked to many first-time founders that sold a company for what would seem like a lot of money and did not end up with as much as they thought they would. So liquidation preference is really important and something to pay attention to. 1x is the most common in the triangle. I've actually been able to get it to melt away before. I got very fortunate in that regard. Usually a price round comes with a board seat, maybe multiples. And then a lot of times you don't want an even number of people on your board. So it'll say, we get 2 board seats and you have 2 founders. That gives us 4. One of you has to come off, so we have 3. You probably don't want to do that. So let's add a 5th, and it'll be an independently mutually agreed to That's a very common configuration, I just said, for a priced seed. An A, you're usually going to get to maybe 7 people on a board, with, sometimes 5 if you're lucky. As founder to founder, the smaller the board, the easier it is just to schedule the thing and make sure people show up, to be honest with you, and make sure everyone's on the same page. I like a 5-person board. 7 is unavoidable at B plus, but if you could keep 5, strongly recommended. I do not sit on board seats right now, so please, you're welcome to invite me, but I'll decline. We have 165 companies, and I can't possibly sit on that many boards. Okay, let's get into the data. So that's a lot of setup, but it's important because I don't want to have to explain all this every single time. So things to remember your caps, remember your pre and post money valuation, remember the 3 mechanisms, safe, convert, and priced, and then remember your rounds, and we're doing it by company progress, not how much is invested. And what that does is it ends up creating a better data set because it ends up being all over the place if you're just doing it by how much. It looks more orthogonal because it'll be like a tighter range, but it's not the reality of what's going on in the world. Okay, so let's there's so much data, you have to kind of peel the onion. Let's start at the mechanism buy stage. So in pre-seed, you see, and this is again very transparent. You can see that we as an entity have invested 23% over these 4 years into this bucket, which represents 2.5 million into 71 investments, 60 safes, 9 converts, and 2 equity. Safe overwhelmingly is the winner in pre-seed. Pre-seed, you know the least about what's going on. It's impossible to do a priced round. You can tell we've had 2, and that is, I think that's the 2 are the angel group that refuses to do safes, basically, and that's why you have this outlier. It's driven by one group that wants to be pre-seed but will not do safes or converts. It's very unusual. Converts are dying out. Those 9, I need to go look at the data. They probably came from 22 and 23. I haven't seen a convert in a pre-seed or seed in quite a while. It's a bit unusual. If you see it in a seed, it's a seed to seed plus. A plus usually indicates I am extending this. I use plus on this series C right here to mean and beyond. So that's a little confusing. I apologize. I should put C-E or something like that, but you understand that now. For this purposes of this, we've aggregated seed and seed plus in there. And a plus indicates a bridge, meaning I'm not quite to the A check marks, and I'll talk about that. I need to raise a little bit around to get a little bit of money from existing investors to get there. Convert is the most popular mechanism for that, but we're seeing safes being used increasingly for that. The founder wants a safe, the investors want a convert. So usually at this point, post-seed, you're somewhat beholden to your existing investors, and it's hard to push back against safe versus convert. So as we move to, let's go ahead and move down one row. So look at row 2, Series Seed. So now we've invested 5.3. This is our sweet spot. This is the $1 million run rate. This is where we want to be putting the bulk of our our time and effort in Tweener Fund. So 49%. And that represents 106 investments. Here you see a pretty good mix. Equity is the winner at 43% coverage of those deals, and then you have safe and then convert at 22. So safe's equity's the winner, and then safe, and then convert. So at this point, at $1 million ARR, there are a lot of firms that will come and do a price round. At my current company, we're going to do a price seed probably in Q1. So it is good to go ahead and get that done if you've got some fair progress, so you can get everything converted, establish the cap table, get a line in the sand evaluation, and then build from there. So it's kind of what people want to do there. I would say if we separated seed and seed plus, you would see equity well north of 50%. But we didn't want this to have 60 rows and have to go through it all, so we aggregated it. Moving on to Series A, now you're going to see, from this point forward, you're going to see the equity rounds really take over, because you don't really want to do you don't want to move the alphabet, meaning go from seed to A to B to C, unless you have a new pricing event. So it's almost like unusual, and if the data that is not a priced round is usually some kind of an extension from A forward or B forward, so on and so forth. It is not a new series name. Okay, so we're going to raise 1.7. We across here we've done 1.7, so we're getting relatively small for us, 16%, relatively unusual, and most of them, I would say of this 27, 23 probably are companies we were in seed that raised around, and then the other ones are going to be opportunities we had with a founder that was further along. One that I can talk about is Playmetrics. They've actually exited, but they were kind enough to let us in their Series A. That worked out great for us because then they had an exit relatively quickly from when we entered versus it usually takes 5 to 10 years. Okay, so in this Series A, you're at 56% equity, 26% convert, and 19% safe. And then from here forward, the safe goes away because at this point, you've raised a fair amount of capital and you're going to be doing a convertible note if you need a bridge. So almost every one of these converts, there's only 3 across these 2, is going to be driven by the investors. You don't really have a choice for a safe. So, and again, this is between B and C, we've done 12%. So very small for us because our portfolio is pretty young. Over time, we'll do more of those. So I'd love to see this smooth out for us over time, which means our portfolio is maturing. All right, so that's the mechanisms used at each stage. Let's look at each stage and do an analysis. So here's the data, and this is a lot to digest. Let me walk you through it by starting with pre-seed. So again, we've done 71 investments. The average cap, so we took all the caps, added them up, and divided by 71, and to get an average, is 8.6 million. And let's round it up to 9, basically. So 9 million is basically the cap. That's down the fairway, and I see this all the time. The average raise is about $1 million. That is the pre-seed vanilla ice cream. $1 million raise, 20 to 25% discount, 10 million cap. Pre-seed. That is straight down the fairway, to use a golf term. There's a wide range here. This is what you're going to notice in all these. It's 150 on the low side raise and 6 million on the high. That 150 was a company that had $1 million ARR and was going to get to cash flow break even and just wanted to top off at 150. They wanted to hire somebody and they needed 150K to do it. And we said, and that was the only money they raised. And we said, well, yeah, we'll help with that. So that's very rare to have a company that's kind of like, that cash efficient, but it happens here in the Triangle. This is another beautiful thing about the Triangle. People in Silicon Valley would look at this and say, well, it's not even worth doing. Why would you raise 150K? Well, this was actually worth it for this founder that wanted like 5% dilution or less and got to cash flow break even. So we have unusual data for people outside of their areas because of the scrappiness and basically cheapness of our companies. But anyway, here on the high, we have a 6 million. So we've had a company in pre-seed raise a really big amount. And this is usually a serial founder that's on company 3 and says, I'm going to raise a lot of money on an idea alone, and more power to them. These are companies, I'm not calling out any specific one, but we have Erkang is raising a company. Like if Igor raises a company, let's say Jess Lipson sold Levitate for $1 bazillion and started another company, he could raise money at whatever valuation he wanted. If Todd at Pendo raised more capital, it's things like that. So we raised, so at Refi Vibe, this is public information, we've raised about 3 million in a pre-seed kind of situation because we have a team and we've been at it a while and we're able to get kind of a little bit towards the high end of these ranges here. Valuation wise, again, a wide range, 1.5 to 30. That 1.5 is representative of these folks that are raising lower, that are seed strapping, and they just really want a little bit of money to get to get there. And then valuation high is serial founders, usually in the AI category, that are raising in a hot market and are able to get outside capital. I don't think any local investors would pay this, except for us, which we just want to be on the cap table. We don't set price. So I think that's a best way to make sure our investors get to a lot of the biggest exits are going to be these. So you don't want to say no to this is our philosophy. Everyone else would say, I'd rather save my powder for another deal. But we don't have to make that decision because we get lots of shots on goal. Discount. So the discount has got a wide range here, anywhere from 15 to 25%. And this tends to go kind of along this sliding dimensions of, I'll talk about it in a second. I'm going to talk about the factors here. So let's talk about it now. So in pre-seed, the biggest factor, there's this saying in startups, bet in early stage, you bet on the jockey and not the horse. And what that means is you're betting on the founder and not the idea and the space. Jess Lipson could say he wants to run a hot dog cart and people would invest, right? Maybe not well, they probably would. So there are certain founders that can override that. And basically this idea of founder market fit is taken hold. We've always had product market fit. Does your product fit the market? Well, now it's kind of like, does your founder meet the market? So let's take the Jess Lipson example. A company that's really interesting, for example, there's a set of people. I'll talk about Opine, OPINE. So that was the three founders were, lead employees at Jupiter One, which was Erkong's company. They started a company, and it was solving a problem that two of them actually solved at Jupiter One. So here you have founders that have worked for a startup that did really well, that became a unicorn, and they worked for Erkong. So they've got some, osmosis there. They are in a space that they understand and built around. It's MarTech and sales tech. They helped. They saw this problem at Jupiter One, and they may have built internal tools. I don't remember, but this is basically the productization of a problem they saw. They are a great product founder market fit. So they're solving a problem. They're first time founders, but their founder market fit is off the charts. And it ends up being and then, so that founder piece is 80% of the weight in this round. So as you look at these differences, that's what it is. So if you're a first time founder and you've been a developer all your life, and now you're opening up a consumer company, that is, and you've never had experience building a consumer company, that's a poor product, a founder market fit. It's just going to be what you're up against. That doesn't mean don't do it. It just means you're going to have headwinds because this is how the world works. It has nothing to do with your idea. It does have to do with your idea, but you've chosen your idea. You're not going to change. Don't change your idea to something you're not passionate about if there's not founder market fit. You're just going to have to take more dilution. That's just that. The risk reward on the other side is way off the charts. So that's what's going on here. So really you have two levers in pre-seed. The idea and space gets some attention, but it's largely feeding into the founder market fit. It's largely the founder. There is a factor here, an AI factor. So we have another company that's two founders, have never, first-time founders. They're new to a space, but they had a really clever AI concept for a space they weren't in, and it ended up being perfect. And they've raised way outside of these rounds, these ranges I'm telling you. They may be some of the ones that push some of these up. I don't know. So there's this AI factor that overloads everything I told you. Like if you can hit lightning in a bottle, then all the rules go by the wayside. We've probably had 5 of those in the last, but they've all been in the last 18 months. So this is a thing right now. We'll see if it keeps going. A lot of these, just like the boom bust cycle, who knows if this will be a thing. All right. That was, so the valuation low was 1.5 and the high was 30. So the 1.5, you could probably guess that's probably the raise low. So there's a correlation there. And the raise high is probably close to that valuation high. There tends to be a clustering of data that has created those endpoints on the bookends. Series seed, this is where you have the most data, 106, average cap, 16 million. We've talked about that. Average raise, 2.5. And again, what you want to do as a founder is get to kind of like this 15 to 20% dilution. So you can do the math on that and see you're getting right to 18%. So it's like right down the middle there, valuation wise. How much you've raised, low and high. Again, these ranges are very wide. Look at this range here. It's a 10x on valuation. And it is those factors. So here, seed, the factors are, now they're split pretty evenly. By the time you get to seed, you're at $1 million ARR by my definition, 80 MRR, 80K MRR. Now you've got 3 kind of an equal balance between the founder, the idea in the space, and progress. So now we've got a new factor, and it is progress. If you get to $1 million, your valuation rattles around very low, and then you get to $1 million, and there is a valuation bump you get from that because there's kind of a magic number there. I didn't know this when I drew the line there. I kind of stumbled. It really wasn't the case in 22. It wasn't the case in 15. Somehow it's become this line in the sand where if you get to $1 million ARR, your valuation goes up. And you can see here, our valuation, if we start to look at the columns, our valuation it basically doubled from pre-seed to seed. And that's what's going to happen. You're going to go from like $8 million valuation on average to 16 when you get to $1 million ARR. So if you can go without raising money to get to $1 million ARR, do that. That's going to be the least dilutive thing you can do. It's hard to do that in today's world, but many companies in the Triangle do. I would say probably 30 of those 106 have. This is their first round, and they're at $1 million ARR, and more power to them. I know companies that, there was a company, Spoonflower. I think they got to like 30 or 40 million before they raised any money. And that was, maybe they raised like 1 or 2 rounds, and all they had was like 30% dilution. More power to you. Okay. So those are the 3 factors. And let's talk a little bit about progress. What does that mean? So at this point, the progress, what the investors largely asking for, and this is not what we do. We're just like, if someone will lead your round, we want to invest. It's kind of our philosophy. The people that lead the rounds, what we hear and from the founders and the round leaders is, I want to know, is the company, sure, you're at $1 million ARR, but are you through product market fit? Is there repeatability to your model? I mentioned a lot of these before, so I won't go through them all, but they're looking for those signals. They're also, you may increasingly, we're seeing some of this used to be, when I started Channel Advisor, unit economics didn't come up until Series B lightly, and then Series C, it's always spent time on. Now, A and seed is spending time on it. So you may start to see that. We'll talk about it when we get to A. It's unusual for it to come in seed, but if you're going to do a big seed, like let's see, what was that big one? If you're going to do a seed and raise 13 million, you're going to talk about unit economics. I would say anywhere above 4 or 5 million raise at a seed, you're going to have to get into unit economics because it starts to feel like it starts to get edge up on these growth rounds. And the idea of growth round is like now not only am I seeing are you through product market fit, but what's the scalability of your business? If I add money, am I virtually guaranteed that it's basically a slot machine that it's going to spit money back out? And that's why they look at unit economics. Let's talk about that. Valuation low. So here again, very wide range between 4 and 40 million in pre-seed. At this point, because you have $1 million ARR, your discount range tightens up. So you see maybe a little bit of a healthier discount, the 25% if you choose to do a SAFE at this mechanism versus a 20. That's going to be consumer companies versus B2B, to be honest with you. Consumer companies always get a discount, much more riskier. The failure rate is through the roof. Failure rate on everything is like 99%. Failure rate on consumers is 99.99%. So investors will want to get compensated correspondingly for the risk investing in a consumer company. Series A, 27 deals here, average cap 34 million and average raise 7.2, and raised low is 500K. Again, these are the super capital efficient companies out there. If you look at all these lows, that's the cohort. There's a cohort of like maybe 10% of the companies we're in that kind of rattle along the bottom of these things and really are optimizing cash flow, return on invested capital, and cash efficiency, and they do not want a lot of dilution. They're the seed trappers, if you will. And then on the high, we have 25 million. That's kind of, again, the sweet spot in this one is 34, and or being raised is 7 million. So that's where that clusters. And then the valuation 10 to 100. The hundreds, you can guess, serial entrepreneur doing AI. The valuation low, seed strapper. So you're starting to see this pattern evolve here, or valuation low, consumer. B2B, valuation high. So these are the factors that really come out in the data when you look at this. Series B, let's just look at the averages. So here, your valuation, your late stage, your $100 million kind of valuation, and you're going to raise 20 or 30. Hopefully, you're starting to get to where you're going to get to cash flow positive. Some companies keep going, others don't. So what's interesting is now let's look at the averages from the top down. So 8.6, let's call it 9 to 16 to 34 to 100. Average raised $1 million, 2.5, 7 or 8, and then 22. So that is the progression that you get on. That's the venture capital fundraising treadmill, if you will. Okay, what should you do with this? Hopefully you found this helpful. I mentioned the factors. So you should know in your head, if you're a founder and you're pre-seed, you should spend 90% of your time thinking about that. But you need to start saying, if I need to raise more capital, I'm going to need to show progress. If you don't, you're not going to be able to. You're going to run out of money. You have to show progress at each stage. And what does that mean? The bar goes up from pre-seed to seed, $1 million ARR. Perfect. If you get 800, if you get line of sight, if you have bookings that can show you can get there, a repeatable model, and you're at 700K ARR, you're kind of given credit. If you're at 200K, you're not, unless you're a serial founder and your pipeline is busting at the seams, and there's some reason. It's like if you're GovTech and it's just taking a while, sometimes you get partial credit. Series A, they're going to drill in even more, because Series A on average, you were raising 7 million. That's a lot of money, and the people that are fiduciary responsible for that are going to do a lot more digging. At this point, you have a data room. They're going to talk to half your customers. They're going to talk to all the other investors. They're going to talk to all your management team. They're going to run through product demos. They're going to have experts look at stuff. They're going to talk to people that aren't your customers you lost. It starts to get much more forensic as you get into A, B, C. They're also going to want to talk about unit economics, and that's going to be how they think about progress. The first layer of progress is revenue, expressed in MRR and ARR typically. The second one is they're going to start looking at churn. At this point, your company's old enough that you've got 3 to 4 years under your belt, maybe more, and they're going to start to look at churn data. Losing customers as churn. They don't care about employee churn unless it's like astronomical. They will look at Glassdoor reviews, and I've had this conversation come up a lot. Some of my companies have had terrible Glassdoor reviews. That's just par for the course. If you fire people for underperformance, you're going to have bad. Unfortunately, investors usually don't kind of understand. They can't. It looks like a red flag to them, and you're going to have to spend some time on it. Anyway, usually you're talking about customer churn. In customer churn, there's 2 metrics: gross revenue retention and NRR. I don't have time to go through those. Google them. There's tons of SaaStr stuff on these things. So revenue is where you're going to start under this column of progress. Revenue growth, MRR growth trends, year-over-year growth trends. ACV, what is your average contract size? How many customers do you have? You're going to be looking at TAM more. That's the idea space kind of factor. You're still a factor. And then a lot of the time will be spent on progress. Retention is important. And are you churning customers? If you have high churn, you get a lower valuation. If you have low churn, you get a higher valuation, because that recurring revenue is going to stick with you longer. If you don't have recurring revenue, you're going to take a pretty big hit on that. And increasingly, there's okay with outcome-based pricing or usage-based pricing or a variable component. A lot of times you'll get almost recurring treatment, but you do tend to get a bit of a discount on that. But if it's non-recurring, you're going to get a 80% haircut on that. Underneath unit economics now, you're going to look at CAC to LTV, the cost to acquire a customer, and the ratio of that to the lifetime value of that customer. Churn is a factor in that LTV. Again, I don't have time to go into these. I'm just going to spit them out, and then you can go research them on your own. They're going to want to know a lot of go-to-market engine data. So they're going to look at your weighted and unweighted pipeline. They're going to want to look at rep performance and the distribution of rep performance across that. How many people made their quota? What is quotas? How are you thinking about it? What are the rules of engagement of your sales team? Are you doing geographies, verticals? How do you set that up? How is that going? Because in these later stages, they're going to want to grow that go-to-market engine. That's going to be the pull that they're investing in. It always surprises tech founders that they spend almost, relatively, they'll spend less than 10% of their time looking at your product. Because if you have, $3 million in revenue, you have a product. It's really, they want to know, they may look at some security stuff. That's probably what and the scalability of it. Like, can it go to 30 million or is it going to fall over? It is what it is. And they're going to look at all these progress metrics, and that's going to tease out things that may come and surface some other deals. So part of CAC LTV is getting to a payback period. So you invest $1 million this year. When you get it paid back, is it
2 years? Is it 6 months? Is it industry standard is if you can get back in a SaaS type business, if you get paid back in a year, you're in a good spot. If it takes more than a year, you better have low churn, or else those things will actually create a bucket that is emptying faster than it can fill. So they're looking at those types of things. They're going to want to, as you get look towards B, they're going to want to take a customer and look at it as if they have their own little P&L and see what is the profitability of this customer. So the cost to serve starts to come up more. So those are some of the things that you look at from a unit economic perspective. So what this means for a founder is I've given you the guidelines for as you're going from pre-seed to seed to A to B to C. You now know as a triangle-based company what the goalposts are, and you know the bookmarks and where you're probably going to land. So this helps you pick a valuation, pick terms, pick a mechanism. Now, what do you do strategically? That's kind of the tactics of this. Hopefully this helps you see that as a founder, you have to manage 4 balls simultaneously. And you can use an analogy you prefer, like spinning 4 plates. Really what you're having to do is hold all this in your head simultaneously, which is if you were an individual contributor at another company, this frequently freaks first-time founders out. Because if you're an individual contributor, you have a bit of a narrow silo that you work in. If you're on the finance team or a developer or something like that, you're in that world. You have to simultaneously kind of like manage all this. So you have to build a great product in pre-seed. And then once you raise money, now you need to be thinking about, all right, to get to seed, I need to get to $1 million ARR. So now you've got to think about, okay, the operational component of that, meaning building the product, hiring the team, getting the go-to-market motion. Ball 2 is I'm always team building and fundraising and company building and thinking about that next cycle. And then number 3 is I need to also think about after that, right? So like right now, we're thinking about doing a seed, but I'm already thinking about what's an A gonna look like. And I need to like make sure I don't do something now that will hose me for that. And then I'm also spending 2% of my time thinking about what's a B going to be about and how am I going to navigate that. And then you have to get good. The 4th ball is the handling of all these balls. So how do you keep all this in your head? I use an allocation framework. I'm going to spend this % of my time on this, this, and this. That kind of helps me wrap my head around it because it can be overwhelming. You can't just context switch willy-nilly because you'll end up driving yourself crazy. Don't do days of the week either. That never works. So you got these 4 balls that you have to manage. If this is something that resonates with you, I'm happy to help you think through this. I help a lot of founders. If you're over $1 million ARR, if you're under, don't even worry about this yet. Just get there, get through product market fit, and then worry about this. But once you're past, I can help you with this. The other thing is the absolute must as CEO and founder is don't run out of money. Because I have met many companies that had a great product and they had raised money and they just couldn't get that next round because they didn't juggle these balls well. And that's basically, if you don't show this progress, you have to have, can you get a bridge? What's your plan B? I've met a lot of founders that they spent so much time and effort on plan A, they didn't have a plan B. Their existing investors were shocked that the round didn't come through. So the worst case scenario is you get rug pulled. So you've got this, you did pre-seed, you've got a seed investor, they get all the way to the 11th hour, and then they decide, well, we had this LP and they were on vacation and this GP came back and he squished the whole deal and said, we're not doing it. This happens. And you always have to have a plan B. How are you going to you have to go to existing investors and say, I need X dollars by Y time to stay alive. And you need to have that prepped and ready. You also need to be planning what's it take to get to the next level. This is your roadmap. Look at these caps and raises. This is if you're on this treadmill and you want to get on it and stay on it, this is what you're going to have to do. And then you need to think through these factors to make sure as you're going from seed to A, you need to start thinking about, Scott mentioned unit economics. I should start tracking this. What is our CAC LTV? I need to learn more about that, these types of things. And the other thing I'm a tech founder, so this is one that's taken me several shots to learn. Building this go-to-market engine is really important and probably the one thing tech founders fail to do. The best way to solve this is get a really good co-founder that's good at this. So you don't have to be. Most of us that are good at tech aren't great salespeople. A lot of great salespeople aren't great coders. There are people that can do all of it. So we'll see. The other thing is hire a really, really good exec to kind of help you with this. Usually they're not going to come from a big company. Don't do that. I've fallen into that trap before. All right. Hopefully this has been helpful. We wanted to make this interactive, but timing wise, I didn't have time to do a live and all this jazz and pre-post about it. So chime off, send me an email, Scot, SCOT at tweenerfund.com. Come over to the Tweener Hub, chat with us on Substack. You can go to the announcement you saw for this pod and we can chat there, chat on LinkedIn. Whatever it is, we're here for the community, and we put this data out for you to answer your questions. Happy to answer any of the questions. Thanks for your time. Everyone have a happy holiday. Hopefully you found this enjoyable. And until next time, happy company building.
Triangle Tweener Talks is hosted by Scott Wingo, presented and produced by Triangle Tweener Fund, with creative assets and design support from our friends at Walk West. That's it for today's episode. A big thank you to our guests, sponsors, and the team that makes this podcast possible. If you enjoyed this episode, don't forget to subscribe, leave a review, and share it with someone who loves the startup stories coming out of the Triangle. Thanks for listening. We will see you next time on Triangle Tweener Talks.